Welcome to this week's edition of the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. This week's topic is going to be reading your financial statements like a pro. And while most of business owners are not accountants, it is highly recommended that you understand, at least on a high level, what your financial statements are telling you, because your financial statements really are a scorecard of your business. So, what are we going to kind of review today? We're going to talk about some of the things that you might want to avoid when you're reviewing your statements, but why it matters. It really is a scorecard for your business. And if you can at least read your financial statements, you can spot any issues and therefore be able to not only bring them to the people that are supporting you with your accounting and your finance, but maybe bring that information to your own accountant and be able to have good conversations about what's going on in your business and where you might be able to make some changes, where you can improve your profitability, and just be able to make better decisions in your business. So we're going to talk about the 3 essential financial statements, what you're going to want to look for in each one of them, and generally how to interpret any trends you may see or any red flags in those financial statements. So let's talk about the 3 core financial statements. The first is going to be your profit and loss statement, or in some cases is going to be referred to your P&L or your income statement. We're going to talk about your balance sheet. And then the last item we're going to talk about is your cash flow statement. So what is that profit and loss statement? Again, as I mentioned, it sometimes is referred to as a P&L, sometimes is referred to as your income statement. In most cases, it's going to show you on a very high level your revenues, your costs, and then your profit over a period. So your profit and loss statement is going to be, again, as I mentioned, over a period, 1 month, 1 quarter, 1 year. So it's going to show your revenues less your expenses, your profit over a period. Again, 1 month, 1 quarter, 1 year. Now with your balance sheet, that's going to be a little bit different. Your balance sheet is going to be a snapshot in time, is going to be one moment in time. It might be the last day of the month or the last day of the quarter or the last day of the year. So your profit and loss statement is over a period of time. Your balance sheet is one moment in time. And it's going to show you what you own, so your assets. It's going to show you what liabilities you have or who you owe money to. And then what's left over, right? The equity in your business. So it's assets minus liabilities is equal your equity, right? Your assets, cash, fixed assets, right? Your equipment, maybe your receivables. Your liabilities are going to be the people you owe money to, whether it be short-term creditors, your material supplier, maybe your vendors. Might be a little bit longer, long-term liabilities. You could owe money to the bank for some of the equipment that you've purchased. And again, what's left over is going to be your equity. And then your last item is going to be your cash flow statement. This is going to track how your cash is moving in and out of your business. It's really going to help you to answer that question, where did all of my money go? Because that is a question we get a lot of times from clients. I have money, it comes in, I don't know where it's going, when it's coming in, when it's going out. So again, that's what your cash flow statement is going to kind of reveal to you. It kind of help you to understand, where did all my money go over a period of time. So let's kind of dig a little bit deeper into each one of the financial statements so that you understand more the components of those. So your first one is going to be your profit and loss statement, right? So what are the key sections that you are going to want to know or understand? So first is going to be your revenue, right? That's going to be what you've earned. Your cost of goods sold in construction is typically going to be your materials and your labor, right? Those are going to be your big numbers in that. Next is going to be your gross profit, right? So it's revenue less your cost of goods sold gets you to gross profit. Next is going to be your operational expenses. These are going to be all the expenses that aren't necessarily directly linked to a project. your insurances, the rent that you pay on your office. Maybe you have some admin staff in your office. Those are your operational expenses. They're not going to go away, regardless of whether or not you make any more money. And then the last item you're going to have is going to be your net profit. So it's revenue less cost of goods sold equals gross profit. And then gross profit less operating expenses gets you to net profit. So again, those are the high level sections that you're going to want to see in your financial statements so that you can kind of get a pulse of what's going on in your business. So what are you looking for when you're looking at this profit and loss statement, this P&L, this income statement? You're going to be looking at your gross profit margin, right? Is it consistent? Is it consistent period over period over period? Is it too low? In many cases, too low makes reference to the fact that you're probably not bidding or quoting on projects correctly and therefore not getting enough revenue in order to compensate for all the expenses associated with a project. So again, these are kind of two basic things you're looking at. Again, one of the things we look at a lot of times, are you getting that kind of the EKG monitor, right? Like dee, 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 go up and down. We don't want to see your numbers go up and down like that. We would like it to see as consistent as possible. Next are your overhead costs, right? Are they creeping up over time? Again, as I mentioned, these are kind of the operational type expenses that go into generating those revenues along with your supplies and your materials and your labor. But are those creeping up over time? Because in many cases, over the length of a number of projects, those overhead costs are going to spread more evenly over those projects and actually should, in some cases, flatten out. So are they creeping up? And if they are creeping up, what's forcing them to creep up, right? And so now you've got something that you need to investigate to determine what's going on. And then overall, your net income is your business actually making money, right? That's a big one. Many businesses, if you are not earning enough in gross profit on the projects, once you add in all your operational expenses, you may in fact not actually be profitable. So, couple of red flags on your profit and loss statement. Your revenue is growing period over period over period, but your profit keeps shrinking. And if your profit is shrinking, what's going on in terms of expenses that don't make sense? Because typically from an overall math perspective, as your revenues grow, you should see a slight increase, if not a decent increase in your profits. So what's going on from an expense standpoint that's causing your profits to shrink because your revenue is going up? And then another big thing to look at is just big jumps month over month in your expenses. So that's one of the items when we're reviewing clients' profit and loss statements. Are we seeing big jumps month over month over month? If 1 month an expense is, $1,000 and then the next month it's $12,000, what's happening in those months? Because we want to make sure that we consider whatever's happening. Was it a one-off thing? Is it a permanent item? And if it's permanent, how are we figuring out how to add that into any future bidding or any projects moving forward, right? So those are the types of things that we're looking for a certain level of consistency. A lot of times when we're looking at historical information, month over month, quarter over quarter, year over year. So let's talk about our balance sheet. So what are the key sections? Your key sections are going to be your assets, your liabilities, and your equity. Again, your assets are going to be your cash, equipment, your receivables. Liabilities are going to be your credit cards, any loans you may have to any financial institutions, accounts payable that you have to, say, your material supplier or any of your vendors. And then your equity, or referred to as your retained earnings or what's left over. Again, equity, when you think about equity in a business, in theory, it's the same as equity in your home, right? You want to have equity in your property. You want your property, your home, to be worth more than what you owe on it. It's the same idea, same fundamental concept with your business. You want to have more assets than liabilities in your business. So why does your balance sheet matter? It matters because it shows the business's financial health at a glance at one moment in time. And this is also, one of the other things when it's not just your profit and loss statement, especially when you're looking at the health of your business or you have an outside party looking at the health of your business. when an outside party, for example, potentially a lender who's looking to let you borrow money for maybe more equipment, can your lender trust you to actually repay them? Do you have the cash available to actually repay that loan? So they're not just looking at the profitability of your entity, but they're looking at the entity's health, which they can see on a balance sheet based on, again, what you have for assets versus liability. There are a couple of basic ratios you're going to want to be aware of when we're talking about your balance sheet. So the first one is going to be your current ratio, and that is simply going to be your current assets divided by your current liability, right? Very simple. And this is simply going to measure your liquidity. So just like when we're looking at assets less liabilities, you want to have more assets than you have liabilities, because that will show how liquid that you are in your business, that you can actually pay off those debts, pay off those payables, pay off those loans. So that's a big one if a lender is looking at your financial statements and determining whether or not you are actually going to be able to pay them back. Another big one, again, is going to be debt to equity, right? Very big one. It's going to be your total liabilities divided by the equity in your business. So what are we looking at when we're looking at that? That is looking at, measuring your financial leverage. Have you been able to, leverage your assets in your business, in order to satisfy this debt? Again, if you're looking to borrow money, this is usually where this is a ratio that someone is going to be looking at. It's typically when you're looking to borrow money. The bank wants to know that you're going to be able to ultimately pay them back for what it is that they've loaned you. Couple of red flags when it comes to your balance sheet. So, very simply, high debt. You have more debt than you have assets. You do not have the assets necessary to settle that debt. So that's a really big red flag for someone, not only someone externally looking at your financials, but something you would want to be able to determine when you're looking at your own set of financials. And another big thing is low cash on hand. Again, cash is typically, or cash flow challenges are pretty symptomatic of the construction industry, but are you historically or always low on cash? Again, that's a big red flag, not only for you as a business owner, but to someone who may potentially be looking at your financial statements. Let's talk about the last set of financial statements, which is going to be your cash flow statement. So, what are the big sections in the cash flow statement? So, it's going to be your operating activities, it's going to be your investing activities, and then it's going to be your financing activities. So, why, when we're looking at this set of financials, why is this important? It's simply going to show if you're running out of money, even if you are profitable on paper, because that's what happens a lot of times with businesses. We see on paper the entity is profitable. I look at the bottom of that profit and loss statement, I see profit, yet constantly cash is coming in. I don't know where it's going. So this is simply going to help us to see, if you're running out of money, and why you're profitable on paper and you are in fact running out of money. Where in all of that, in your operating, investing, and financing activities, is that becoming a problem for you? And it also can help you just do general cash flow planning. So planning for payroll, planning for, again, materials and labor, which tend to be really big numbers for most in construction. Those are high burden numbers for you. And also taxes, right? The goal is, if you are profitable, you want to be profitable. And with that profitability comes some level of paying tax, and you want to be able to at least pay that tax. You want to have the cash flow to do that. So cash versus profit. This is a very, very big one. Again, just because we look at the bottom of a financial statement and we see that you're profitable, that doesn't mean that that's the cash that you have on hand at that moment in time, right? So you look profitable on paper, but when we look at your cash, you actually don't have the cash, right? There's a lot of timing going on in there. So but profitability does not equal cash, and cash does not equal profitability, right? So, you know, in many cases, it's like I said, it's timing, right? You've not been paid on a project, but you've already outlaid the cash on that project for, again, materials or potentially supplies. So I'm profitable on paper, but I don't have cash in the bank, right? So those are going to be two different numbers. They are not going to equal each other. So How are you going to use these financial statements? Because the goal is that you, as the business owner, want to be the one using the financials. Again, your financials are going to be something that a third party may, in fact, look at, but we want you to be able to look at your financials and at least get a good glimpse of what's going on and be able to, again, ask additional questions to someone else, for example, your own accountant or your own CPA, about, your financials, and really just be able to have a general conversation about that and be an informed business owner so that you can, in fact, make really good business decisions. So how are you using them? So you're looking to spot problems in the business. Do you have a problem job or a project that you're working on, or a service line that's a problem for you? You want to be able to spot those challenges and make an adjustment quickly. So if you're looking at your financial statements, you can start to make informed decisions about things like, challenges or problems in your business. And again, make a pivot in another direction, or make an adjustment in order to fix that challenge. Little things like we see a lot in construction, it's going to be, do I have money to hire people and do I have money to buy equipment, right? So if you're looking at your financial statements and you're looking at your balance sheet and your statement of cash flow, now you can start to make determinations as to whether or not you in fact can hire people, or you can in fact afford to purchase that new piece of equipment. Another thing you're going to want to do is you're going to want to plan for taxes. We talked about it just a moment ago. If you are profitable, you will be paying some level of tax. No CPA or EA wants you to pay too much in tax, but if your business is profitable, you're going to be paying some tax. So you want to be able to plan for actually making those tax payments, right? When are they coming? When's the next one coming in? And so on. So again, you want to be able to do some level of tax planning, and you're going to need to use those financial statements to start to make determinations on the best route or the plan of action when it comes to your taxes. And you're also going to want to use the trends that you've seen in your business to improve your estimates, to improve your pricing. If you see that there is a specific cost that has generally over time gone up, you're going to use that knowledge in order to make changes on how you estimate or your price moving forward. So those are the things that you want to be able to take away or learn from your business, and you learn from those financial statements and make the changes that you need to do in order to, again, maintain your profitability or increase your profitability if you are not as profitable as you would like to be. So a couple of basic tools when it comes to financial statements. I talk about financial statements. Again, we talked about the three specific, but most clients are on some type of accounting software. Ours typically are using QuickBooks. There are a handful of products that are people are familiar with: QuickBooks, Xero, FreshBooks. Those are all accounting software products. Again, these are going to help you to generate those financial statements in a little bit of a quicker fashion versus using an Excel spreadsheet, for example. So if you're using these products, which most clients are, what do you need to do with that? Well, you need to generate your reports, right? Your financial statement reports. You want to be able to, at minimum, generate a monthly profit and loss statement because you want to see what's going on monthly. You want to be able to generate that balance sheet, that snapshot, that one moment in time. So that might be that last day of that month that you're looking at. And you want to be able to do cash flow projections. That's a really big one, especially in construction where timing can be such a challenge. You invoice a client, and in some cases, you could be waiting a significant period of time before you're paid, but yet you still have cash going out the door related to those projects. So you want to be able to project where the cash is flowing in and out, when it's going to come in and out, and project your cash that way. And at the minimum, we talk about it on here all the time. You really should be looking at your reports at least monthly. Do not wait until tax season. Do not wait until January, February to do all of your financials for the prior year. It does not give you the opportunity to make any fixes that will help you if you're waiting that far. And to be completely honest, doing any tax planning in January, February for the prior year is almost non-existent. It leaves you very little wiggle room. So if you are in fact tracking and managing your financials on a monthly basis, you really want to be looking at those on a monthly basis. So common mistakes to avoid, when it comes to reading your financial statements and maintaining them. Many people ignore the reports altogether. They never look at any of the reports ever. The only time they might look at something again is at year end when they know that information is going off to the accountant, the CPA, the EA for tax preparation. Another common mistake we just talked about a moment ago, which cash versus profit, is people confuse the two. They confuse profit with cash. They are not the same thing. Just because you're profitable on the bottom of that financial statement does that not mean that you have that cash in the bank. In some cases, another big mistake is failing to reconcile accounts. If you aren't reconciling and ensuring that they tie back to the actual documentation, you don't know that you've in fact captured everything. And that can be a challenge. So we reconcile cash, credit cards, debt every month. We want to make sure we've captured everything appropriately in that set of financial statements. And there's two ends of the spectrum. Some ignore the reports altogether, some review, but they do not review on a regular basis. So we recommend that you always review at the least on a monthly basis. That way you only have a month's there. You have the opportunity to make any fixes. You haven't gotten too far down the road where it's harder for you to make adjustments and make fixes. So kind of some quick, reading your financials like a pro. So just a couple of quick checklist items. Your P&L, your profit and loss statement. Check your gross profit, your net income, and you're looking for expense spikes, right? Are they shooting up month over month for no reason? On your balance sheet, you want to look at your debt levels, especially in construction, because much of what you're doing is going to be debt financed, typically through some level of equipment, heavy equipment, etc. And what are your cash reserves? Because you're probably going to be waiting a period of time for your customers to pay you, yet you're still going to have cash going out the door to your materials suppliers as well as your subs. So you want to make sure you understand what you have for cash reserves. Your cash flow. You need to know what your runway is. When are you going to run out of cash, or you're going to get very tight on your cash? You don't want to be surprised on a Monday that you can't make payroll on Friday. That's something that if you're projecting your cash out 13 weeks, you could see that in week 5, I'm going to run low on cash. I need to figure out something in the interim. And then looking at trends, you want to compare month over month over month. That is incredibly important. Those big spikes or those big changes month over month can be caught with adjustments made. And the other thing is you want to look at year over year. What happened year over year in my business that made that different result? What did I do well that I want to keep doing? Or what did I not do well that I don't want to continue to do and I want to make an adjustment? So I know we talked a lot about financial statements. My hope is that what you walk away from this is that you have a general understanding of how to read your own set of financial statements. Again, as a business owner, you don't need to be an accountant, but you want to be generally educated on how to review those statements quickly and again, spot any errors or issues that you may need to that you might actually need to look at and make adjustments in your business before it's too far gone. So again, any of you can read your financial statements. Any of you can run your business like a big CEO. You just need to have some basic tips, and these basic tips that we went over can make things super helpful. And as always, reach out to your local CPA, the one that you're working with, or your EA, if you're looking for additional support when it comes to reading your financial statements. And as many of our owners are solo owners, so they look to us to actually bounce things off of and helping them to not only make better decisions in their business, but educating them on the best way to make better decisions in their business. As always, we look forward to seeing you here every Friday. Have a wonderful weekend, and we'll see you here next week.